Welcome back, everybody, to Rise Capital on finances and investing. Today, we've got Matt Meyer with Teuscher Walpole, LLC, CPAs. Matt, you're local here in Salt Lake as well as we are.
Yeah, we have an office in Draper, Utah, right? Been here for a long time. The office has been open since 2010. We have 5 partners at the firm. Been here doing tax and working with real estate professionals for a very long time.
Yeah, so I think what kind of caught my interest when we were here at the Best Ever, and I'm walking around looking at all the booths. Well, first of all, I drive by Teuscher Walpole pretty much every single day.
Well, thank you. It's a pretty nice building over there.
I think my daughter works in a building not far from there, and
Oh, awesome.
you have the beautiful backdrop of the mountains and then Cowabunga Bay Water Park, so
Right?
it's easy to find. So when you're first telling me we're over by Lone Peak Hospital, and then I'm like, well, where is that exactly? Like Cowabunga Bay. I'm like, okay, I know, I remember.
It's fun watching them from the office in the summertime,
Yeah.
wishing you were over there, right?
Yeah.
So that's good.
Yeah, it's a great location, and I feel like when I saw that you were doing cost segregation, I didn't realize. I was like, wait. So this gives you deep real estate experience with the cost segregation side of real estate evaluation. So can you start out with your personal background, what it is that you do for the firm, your own professional background that kind of led you to that position, and then a little bit about the cost segregation and the real estate side of the CPA, and then we'll kind of get into ways that investors can save money on taxes.
Sure. So falling into the CPA world, it was a great opportunity for me. So Mike Teuscher, our managing partner, is a fantastic man. We've built a business word of mouth for a very long time. So I went to University of Nevada, Las Vegas. I was recruited by eBay up here in Salt Lake in 2008. I worked with a few tech companies, running some partnerships. So I'm a BD guy. I'm a business development sales guy. So kind of the big picture thinker. And for Teuscher Walpole for the past 4 years, I've worked as the cost segregation consultant, just subsidiary business. And I've managed the sales organization from that side. And now for the past 9 months or so, I've been running business development for the entire firm and building out all our strategic initiatives.
Okay. So, I know you've said you're not a CPA, but one of the reasons I wanted to talk to you is because I'll give you an example. Like one of my very first investors, we were just chatting, like, what do you do? And he said, I'm in medical sales. And I said, oh, what does that mean? And he said, well, I'm medical device sales. Our company creates devices. And then part of my job is not only to go to the physician's offices and sell them on the device, but after they buy it, I am there in the emergency room telling him how to install it because I know more about the device than the doctor does. Because I was like, wait, you're in the operating room with him, all smocked up everything. And I said, why do they have the sales guy in there? He said, because who knows more about the device other than the engineer than the sales guy? And so I feel like business development, you are big picture, but you also understand a lot of the technical details, but you don't tend to get as lost in the weeds because you know how to explain it to an average human. So I think that's why you make a great guest to be able to just kind of explain this whole overarching world of tax planning and
Bring it down to the
investing.
layman's terms so everybody can understand it,
Exactly.
right?
Exactly. I always say, like, explain it to me like I'm a very bright 5th grader, right? So, all right. So talk to us about what is cost segregation, first of all. How does it help real estate investors? And then we can kind of get into how that can help investors in general.
Sure. Well, let me give you a little hierarchy overview, right? So Teuscher Walpole, being around as long as we have, right? We have a lot of clients that are commercial real estate investors, right? And a lot of small to medium-sized business. And we've helped them navigate the pitfalls of tax and just other tax strategies to be able to take away tax liability, right? Over the years. And cost segregation is something that naturally has fallen into that because that's a different tax strategy. There's multiple tax strategies for companies to utilize to offset income, right?
Mm-hmm.
And, basically utilizing cost segregation is something that happened from 1997. The Hospital Corporation of America went against the IRS because they found some loopholes to be able to take advantage of some of the things that accelerate depreciation. So in layman's terms, what you're doing is you have either a 39-year property or a 27.5-year property. If it's multifamily, it's 39 years commercial real estate. And there's something called straight line depreciation where you're writing off a piece of that business or a piece of that asset every year over that lifespan. And that's called real property or straight line depreciation. In cost seg, you're turning some of that property into personal property with a shorter tax period. That may be a 5, 7, or 15-year life instead of a 39-year life. And you're taking a percentage of that overall asset and accelerating it that way and writing it off faster. So let's say I'm going to use kind of small numbers, but that makes sense here, okay? Say if you purchase a building for $1.2 million, or if you buy an eightplex for $1.2 million, the IRS says, okay, well, you have to find a land value because you're not allowed to accelerate depreciation, or you cannot depreciate land, dirt. You just can't do it. So you have to find a land value. So you got 1.2, let's say land is $200,000. So you remove $200,000 from your purchase price of 1.2, and now you have what they call $1 million building basis. You have a building basis of $1 million. Let's say in 5-year life, so there's different lives. 5 years is what's inside a property of the assets that you may be able to accelerate. 7 years is in office things that are inside. So say if you have any common areas, right? Those are 7-year assets. Or 15 years are your land improvements, or things that are on top, like driveway, lighting, exterior lighting, things like that. So 5 years, let's say we go in and do a study, have engineers that'll go out to a property. They look at a property, they're taking measurements, they're reverse engineering the building, coming up with cost of those assets that qualify for short life property or personal property. Let's say we come up with $100,000. So now that's 10% of that $1 million basis. And at 5 years in accelerated depreciation, you can write $20,000 a year off for 5 years. It's the time value of money concept. I want my money today. It's going to work more for me now, and it's going to be more valuable now than it is 7 to 10 years down the road. So with that $100,000 that I can write off in a deduction, I can take that and use that against my tax liability, or I can make improvements to properties that I already own, or I can go and purchase new properties, right? And take that money and offset and use that and work that money for future growth. So purchasing new inventory or new properties now with some of those tax savings, you're doubling down your efforts. You're getting more of that money back because you just initially invested it. You'll get it back, and then you'll be able to invest into more property, which should have a rollover effect and be able to help you make more money later on.
Okay, perfect. Now, who would be a good candidate for cost segregation? And I'll give you an example. When you're having a syndication and you have limited partners in that syndication, and maybe both of the couple that's investing in that, they both have W-2 jobs. And they're like, hey, I heard I could save a lot of money on my taxes if I can get some real estate in my portfolio. And oftentimes I find that, especially the W-2, is a little bit disappointed that they can't use as much of that depreciation as they thought that they could. So tell us, like, who can use depreciation? Who's a good idea to kind of rack that up? When can they use it? Because maybe not this year, but maybe in a capital gains year. Who's the best one? Who's going to get this study? How do the investors share that? Just who makes a good candidate for this?
We could talk for hours on
Oh,
that
yeah.
concept.
But
can
we
go
only have
forever.
20 minutes.
Okay, so I'll do my best. So it depends, right? So syndication, you may have 4 or 5 tick interests, right? You have a few people that are involved in the overall study or overall project. Some of them have, maybe 10% interest, some of them 50% interest, controlling interest. Some of the investors, like you said, may be W-2 earners, and they say, hey, I want to invest some of my money in this. Well, you have W-2, which is active income, versus things for an investment purposes, what are considered passive income. And passive and active income are treated very separately, or very uniquely and separately from the IRS perspective. And you normally cannot offset each one unless you qualify for certain, maybe material participation or other things where you can be considered maybe a real estate professional to be able to turn that into active income. And those are things where you would really need to talk with your CPA. And that's one thing that we've done very, very well over the years. And we've worked with a lot of clients in real estate investing, from just a few properties, 1 or 2, maybe 3 properties, a few 4-plexes, 8-plexes, all the way up to over a few $1 billion in assets under management, and work with companies all the way through the gamut. And there's always unique strategies being implemented based on their needs, right? And from a cost segregation perspective, maybe not everybody in the partnership will benefit, right? Or see benefit initially, right? And some of those benefits take years to foresee. So from a W-2 perspective, if you have someone that has a few W-2s, they come in, they see that, oh, wow, we can use this cost segregation study methodology, and wow, I can get 25 to 30% back on my investment right away in income. if bonus is 100%, which is a whole nother thing.
Yeah.
But let's say they get 30%. Well, they can't use it against their W-2. So now you have to suspend the loss. So you suspend that loss until the passive income catches up.
Mm-hmm.
Or here's the best part, and we do this with a lot of our clients, maybe in 5 or 6 years or 8 years, they're going to sell that property. And that property now has gains. And we're going to take the money from the cost segregation study that they utilize that's been rolled over and offset it against the gains, and hopefully it nullifies it.
What does it mean when you sell a property? Because this is, I think, where some people get confused. They're like, well, I have to recapture that depreciation when at the sale, but then I'm going to use that depreciation to then offset my capital gains. And then how does that work?
So recapture is a very unique thing. So we're talking about two separate things
Yeah.
actually here, right? So recapture happens, what you're telling the IRS when you're doing a cost segregation study, say, hey, I'm actually going to hold on to this property for a long period of time, and I want to take advantage of some of the short-term life that I can offset because I'm going to hold on to it longer, right? So carpet, for example, is a 5-year asset. Well, I'm going to hold on to the property for 10 years. So I want to offset my carpet, my 5-year, right away. So you take that up front. And let's say if you sell within year 2 or 3, there's some recapture that can happen. And then you get taxed on the ordinary rates when those things happen, but there's ways to mitigate that.
Yeah.
Which at our firm, there's some unique strategies that you're going to employ to save another 17 or 20% against that when you're at the sale of the property.
Okay, so it's two different buckets that we're talking about,
Yes.
but at the end of the year, you're putting all the things in, you're taking all the things out, and what you end up with is a total tax bill. And then you're able to use different strategies to some of them are gonna benefit you, some of them are gonna hurt you, but hopefully the net would be a benefit that your tax situation is improved.
Hopefully you can offset whatever that liability is, get close to zero, or even happen to have a refund.
Okay. Yeah.
So
Well, and I think that's really where we decided that taxes were interesting, because when we first got involved in real estate investing, we weren't paying a lot of taxes. We have 6 kids. Like, we're not high income earners. Like, we've never really thought about saving money on taxes as a thing for us. I was a solo entrepreneur, so I was basically paying taxes as a Schedule C, and but we weren't just paying a lot, and so we never really thought about it. But when we started making some money in real estate, and the first time I saw a big refund, and I was kind of sat back and I was like, no, refunds are bad because you're supposed to not be loaning that money to the government. And I said, well, what did we do wrong? And I went to my tax preparer and said, like, why did we get this big refund? I want it to zero out. And he's like, there's nothing we can do. There you have exemptions, you have 6 kids. They're as high as they can possibly go. You have a lot of depreciation. And I was a real estate professional because my husband was W-2. But I was working in real estate full time. And so we just had this massive avalanche of tax benefits coming our way. And we got that big refund. And I went and bought a rental house with it. And I thought, I just got a free house. And suddenly taxes became much more interesting to me at that point, because I was starting to see them as another stream of income rather than just this annoying form that I had to fill out to get, like, a $500 refund at the end of the year, or pay $500. Now we were talking about big tax bills and big refund possibilities. So there's nothing like having it applied in your personal life to suddenly make it more interesting. So I know that the listener on this might be like, I don't even know what he's talking about, right? But when you start going down this path, go back and listen to this, because it starts to make more sense as you get more into it, and it starts to get way more interesting as you actually start to see it making a difference in your bottom line.
Yeah, but what the new investor is trying to do, what we're trying to do here is accomplish, let them use the money that they have to work for them. So they're setting themselves up for success later on, and having a little, something available for like your kids when they get older, right? Setting up for success. And at the firm, there's a lot of clients that come in all the time, and what they're trying to accomplish is, hey, how do I keep more money in my pocket? How do I make sure that my children are taken care of later on? Man, they have colleges that we're going to have to pay for, and there's $40,000, $50,000 in college fees.
I have 5 daughters who need 5 weddings.
So I have
Yeah, all
4
sorts of
daughters
kids.
and 2 boys, and they're heavy in the sports,
Yep.
and I have 2 of them in college right now, and I'm helping take care of those fees, and they're living on campus and all those things,
It's
right?
expensive, yeah.
So, and when you say you're a Schedule C, right? Schedule C, sometimes there's ways to leverage other
Hmm.
entities to be able to save even more money.
Yeah.
And then you plan other strategies around that to maximize and offset your tax liability, so you're
Hmm.
making more money. And then you start using that money and investing it in certain types of properties that will yield gains, or that you can, based on whatever that strategy is. Maybe it's flipping some of those, maybe it's holding on long term and building a nice portfolio.
Yeah.
I've over and over and over again, we've worked with a few many of clients that come in and they buy 3 or 4 properties. Next thing they know, wow, we're seeing some of this liability. Then they run and do some cost segregation studies, or using qualified improvement property or other tax strategies that are yielding them major returns. And then they start taking those extra funds and investing them in larger projects. Then you have a portfolio, and maybe you're looking for investors, and then you're building partnerships out. And then next thing you know, from $1 million projects, you're in 40 or $50 million projects.
Yeah.
And then where's your passion,
Okay.
right? What are you looking for? What do you want to do? Where do you want your properties to be? And what type of industries do you want to be in?
Yes.
It gets very interesting.
And this is not a DIY kind of project. I know we've got a buddy who heard this on a podcast and went and commissioned a cost segregation study with just a specialist firm. They didn't do any of the tax planning or the accountants like what you do at Teuscher Walpole. And basically what happened is when he brought the results to his CPA at the end of the year, here, file my taxes, I had a cost seg study done on all my rental properties. And he said, you and your wife both have W-2. I don't know why you spent the money on this. He said, why didn't you talk to me about this first? Because he couldn't use that depreciation because he was making over $100,000 and that was being phased out. And he's like, I spent more money on that than it ended up saving me. So that's why I'm saying this is not a DIY kind of thing. And it's important to have the entire solution. You got to have your tax prep, your tax planning, your real estate consultation that goes along with that. The people who understand real estate and cost segregation, which is I love where you have that subsidiary business because it makes you more of an all-around firm.
We see the holistic approach, right? We take a holistic approach to it, and because of our overall arching company, right, being CPAs,
Hmm.
and have decades and hundreds of years backing this. When we're doing a cost segregation quote for someone, we're asking, hey, are you W-2 learners? Are you considered real estate professionals? Have you heard of some of these pitfalls, right? Now, could you take advantage of it? Yes, if you're new investors, sometimes you don't have any passive loss,
Hmm.
right? Or passive income from your real estate
Hmm.
investment to offset any of that income. And you have to utilize certain strategies to think about, hey, what's your exit strategy and other things like that. But you're absolutely right. So from a firm perspective, we try to understand the entirety and the complexity. And we also let our potential clients know, hey, here's some of the ideas that we have. I want you to go run those by your CPA. Have you discussed this with them yet?
Hmm.
Well, no, I just bought it and my buddy told me X. Well, that's great and all, but how does it work for your particular situation? Because everybody's situation is unique
Different.
and different. And you have to have someone that has a wealth of knowledge and a breadth of knowledge, especially in accelerated depreciation at cost seg, if you were going to go down that road, to be able to understand if that's going to be something you can utilize.
Hmm.
So if you look at the tax code, from Great Salt Lake right here to maybe Venice Beach, it's a very on a linear line. It's extremely long, right? It's extremely complicated, and cost segregation is this little sliver in that line, a little crack. But it might as well go to China from here with the area of expertise that you need to have to be able to do it correctly
Hmm.
and to be able to understand all the complexities. So that's where I think we definitely differ because of our history,
Hmm.
and like you said, having the overall knowledge of every aspect to be able to justify the positions that we're taking, and utilizing the IRS code to our advantage
Yeah.
or to the client's advantage is extremely important. So I
Well,
agree
and
with you.
that's where the value of podcasts like this come in, though, because I have gotten bad advice from my accountants. I remember in 2018, I was just like, I'm buying real estate, I'm new rental, new landlord. And so I was looking for an accountant because I knew that our accountant who was doing my Schedule C stuff before, he's like, I don't really do the Schedule E stuff. Like, I can't really help you. with where you're going. And I was grateful for his honesty there. So I went on the hunt for a new accountant. I'm sitting there beginning of 2018, and he's talking about um, basically rules that had changed in 2017 for with the Jobs Act. And I remember
Jobs Act.
sitting there like, it's 2018, and I just heard this on the news, and I don't think he's telling me the right thing. And so I'm smiling and nodding, and I go home and I look it up, and sure enough, what he was giving me was incorrect. And so I felt like, wow, all right, that's what really drove it home, that these kinds of podcasts and this kind of education is not for the DIYer, at least not in this situation.
Mm-hmm.
This is for us to be able to know what questions to ask to find qualified professionals who are giving us good advice, not outdated or not outside of their area of specialty. So when you're learning this, it's important to learn, but also important because it's you have to have professionals do this. This is not something that you're going to take on your own.
The biggest piece of advice I can give anyone is, one, seek someone that you can trust, that you get along with, that you can also have an open-ended conversation with them and be able to, regurgitate your entire strategy, everything that's going on. Don't hold back. Let them know.
Mm-hmm.
And the more often you're having those type of conversations, so it's not once a year at tax time, right? Because then we're playing catch up, or we're trying to do all these different
You're filing
things.
all those returns, and you don't even have time to do tax planning.
Right. Or you're trying to implement some planning last minute, and it doesn't work
Should have
because
been
you need to
working
be
on it in
doing this
January.
right. And you need to keep track of certain things over the
Yes.
entire year.
Yes.
So having those conversations up front, having a CPA firm and a firm that you can trust, that you can have ongoing, meaningful conversations with, that will help you plan and utilize and change the methodology and be able to pivot, right? You may set a strategy. There's been plenty of times where we set a specific strategy and the client decides they want to conduct business in a different way 6 months
Mm-hmm. Or
into
that an
the
opportunity
year,
comes up that
where
we
there's
didn't
an
foresee.
opportunity, right?
Mm-hmm.
And then you're adjusting, right? And you're helping leverage. We had a client that went in and bought, bought a pretty large franchise, and we sat down with him before he signed the closing docs, what she was getting ready to do over the next few days, and we said, hey, have you thought about this? What does this look? Can we look at the closing docs? And basically, we changed some of the verbiage from the seller side, and we saved them $2 million in deductions because of that,
And
from one conversation over 10
yeah,
minutes.
and that was worth whatever the cost that they paid. And this is one thing, is I'm a cheapskate. I'm a DIYer, which is why I'm bringing this up. And when you're listening to something like this, there's a wealth mindset and an abundance mindset that happened to me when I started consulting specialized professionals, because I was like my declaration to go in and say, like, I am planning on making a lot of money doing this. And I want to make sure that my hard work is being as lucrative as possible, because I got 6 kids, and every minute that I spend away from my kids doing business or trying to DIY my own taxes or making mistakes that's costing money is more I have to work and more time I have to spend away from them. And so when I finally got to that point where I decided that this is what wealthy people do and I need to be wealthy people, and there's a switch that goes off when you finally start getting good tax planning and good advice that almost allows you to then focus on your area of expertise and then grow from there, because you know you have a responsible team behind you making the most of your efforts.
And it is a team. Even at the firm, we utilize industry experts in other siloed, maybe tax law, right?
Mm-hmm.
Maybe there's financial planners, whatever it may be that we work with, that we trust in the industry for over a long period of time, decades of a relationship that we've built. Uh, it's King Arthur's table, right? It's the
Mm,
round table.
yeah.
You have to have people you trust. You have to be willing to have those uh, open conversations and utilize everybody's area of expertise to come up with a single focused event to be able to really drive success and hopefully make generational wealth out of that,
Mm-hmm.
right? Which is extremely important
Yeah.
these days.
There's an ecosystem effect to it. I liken it to sports. If you're on a sports team and you have your head coach, you have your forwards coach, you have your backs coach, the forwards coach isn't doing something different than what the backs coach is saying. The head coach is kind of helping everybody to have this unified approach. So yes, you're going to have multiple people on the team and multiple people sitting at the round table, but somebody has to be aware of all of the moving parts so that they can coordinate between the different specialties. And I think that that's where that ecosystem approach really comes into play.
Yeah, I love that you say that, because Bill Walpole, from Teuscher Walpole, he's one of our founding members. Bill loves to reference sports teams and to
Yeah.
utilize those analogies a lot. He does that with baseball or football. So it talks about the quarterback compared to the wide receiver or
Mhm.
defensive end. And you got to be able to, one, be the quarterback or the coach should be able to utilize everybody's expertise effectively.
Yeah, so many good life analogies in sports. But so one of the reasons I wanted to bring this up with you is because of the disappointment factor that a lot of investors have when they come to us at Rise Capital and they say, "Hey, I heard from a podcast or a buddy that I should be getting into real estate so I can offset some of my taxes. We're high income W-2, both of them. And then I have to burst the bubble because most of what we do is private lending, which is interest income, and that's taxed as ordinary active income. And depreciation, we don't have depreciation. We don't own the property. It's a mortgage note. We're like the bank. And so the tax benefits that they're looking at from getting from real estate, they often will come away deflated. And sometimes they're so disappointed that they don't see a way to be able to add private debt to their portfolio because they're so focused on the tax portion of it. And I had somebody say to me recently, and I'm glad she said it instead of me. She was very disappointed. And finally, she said, "You know what? You know what would offset my tax bill?" I said, "What?" She said, "Earning more money." She said, "This would help me pay for those taxes that she was expecting." And I said, "That's one way to look at it." But then we got into a conversation about some other things that the investor could do to add private money, which is very stable, kind of low risk, first lien. I love it because it's not sexy. It's just boring. It's kind of a foundation of my cash flow strategy. But I have to have other tax mitigation things in play to basically offset my active income that I'm earning off of interest. And so that's why I like this conversation because man cannot live on private debt alone.
Right.
There have to be these other things. So, for example, we bought an RV park. And the one reason we wanted to buy the RV park was to have a little bit of equity appreciation because, debt is fixed rate. But we also wanted the depreciation and we also wanted that cost seg because an RV park is depreciating on a shorter schedule because it's mostly underground infrastructure, pipes and things like that. And so I think it's you correct me, like a 16-year for the depreciation on that. So there was a lot of upfront depreciation for our interest investors. And so I just want to show that this is like a multi-pronged approach. There's no one silver bullet.
There's not one silver bullet, and you may look at other aspects. So RV parks are 15-year life, right? There's a lot of land improvements that are happening with that. And then there's certain percentages that you can offset from that, maybe 20, 30, maybe even sometimes 40%.
Oh, it's like 80%.
Right. It could be much
very
higher.
high. Yeah.
It depends on the assets that are within. Not every RV park is the same. It may be a dirt pad, right? Or it may have some serious infrastructure, like you were saying, with
Ours was
underground.
old, so I
Right.
think
So
that's why
there you go. So
yeah,
and
it
it
had
depends.
more.
And then also, so you bring something else up. It also depends on how what your plans are to renovate. And there's stuff called there's some tax strategies called qualified improvement property. You can over the next few years as you make these improvements, you can offset using that strategy and turn all those costs in the 15-year life and expense them or capitalize them differently, right? And then maybe it's not just an RV park. Maybe there's different types or different elements of real estate that you want to get into, like you're saying.
Yeah.
So there's ways to increase your passive income quicker and even get into other types of deals. It just all depends on what you want. And that's where coming and speaking with a professional that has a breadth of knowledge, has done this many a times over, many members of my team, can provide a lot of insight and a lot of opportunity that you probably wouldn't see in an ordinary conversation.
Yeah, and I think this is where that statement, when all you have is a hammer, everything looks like a nail, really comes into play because this is one of those things where you need a full toolbox, and none of these are sledgehammers. None of these are giant saws. They're little chisels, planes. We're just shaving off a little here, we're shaving off a little there. And the example that we gave earlier, like I'm a real estate professional with 6 kids, and that really changes my tax situation from somebody who's not a real estate professional who only has 2 kids. And so even something my kids that have nothing to do with real estate is going to change my tax situation. And that's why it's so important to have a full complement of tools and realize the child deductions are only a small part of this. The real estate is a big chunk of it. And then we have other little ways that we'll shave here and shave there. And it's just very important to have that personalized
Absolutely.
approach. So let's talk a little bit about saving taxes now versus saving taxes later, because you mentioned carrying forward some of those losses to offset capital gains in future years. So even if you can't use it this year, maybe you can use it in future years. And also let's talk about retirement, saving taxes in retirement, because sometimes I think that if you have two very high income W-2 earners, it doesn't make sense for one of them to quit their job and become a real estate professional because they make too much money over here or a career that they're very passionate about. And so they're like, okay, we're going to give up on that one. But there are other things they can do to save money on their taxes now. But a lot of times it comes down to, well, we're just going to suck it up for now and we're going to plan on saving taxes in future years or in retirement.
I strongly suggest getting with someone in accounting, good with the CPA firm that has some expertise around working with high income earners and be able to develop plans moving forward, right? So there's unique strategies that you can use for this year already. I mean, we're already at the end. Things have already happened. So they kind of are where they are. But understanding where things are, especially when you have two doctors in-house or, here in Utah, we work with a lot of high net income earners or a lot of high wealth earners that are in tech sales, for example, right? And some of them are definitely 7-figure earners. And you have to come up with unique strategies. They come and they say, hey, well, I want to buy this, home or buy these two homes and offset all this income that I have to give the IRS because of my W-2 sales wages, right? And it's, well, hold on, this is not how this actually works. And you speak with them and you talk with them about other opportunities and things that they can do. There's a lot of workhorse strategies that we call them in the industry, where you can utilize maybe 5 out of 10 unique things to plan for the next year or two, and really how to offset and gain back some of that income.
Yeah.
Right. So sitting down, having the conversations with the expert now is extremely important, right? Because the planning stages at our firm, our planning stages for this coming year start in October.
Okay.
But even now, even sitting down right now, it's not too late. We have what, 9 months out of the year left? So we can still sit down and come up with a very valuable plan and address that plan and attack it, where we're having, every other month or every 2 months having a meeting and be able to address those situations.
Yeah. And I always think it's important when you're having a tax conversation to clarify. I'm paying all sorts of new taxes now as a business owner, real estate investor that I was never paying before. Much more sales tax. I buy a lot of carpet. I buy a lot of paint. I buy a lot of this kind of stuff. So I'm paying a lot more sales tax. I'm paying payroll taxes, property taxes. Like I can't even, it's unbelievable how much property taxes we pay. And so I think it's important to say that we are moving some of that tax burden around. We're paying a lot over here. And so we want to be able to save taxes over here. And I think that's the whole point of the tax code, is to incentivize me to go out and pay a lot of sales tax and to pay a lot of payroll taxes. And so that my capital gains taxes and my income taxes are being offset to incentivize me to go do some of those other business activities, which is why W-2 earners oftentimes are taxed in the worst, they have the worst tax situation because they've got a job, stable income. They're not really out there hiring people and doing all that. So it's important to understand like why the tax code is the way it is, where I am paying taxes versus where I'm not paying taxes. Because a W-2 worker might be like, oh, I have to pay a lot of cap gains or I have to pay a lot of income taxes, but they're also not paying all the payroll, property taxes and all that either. So it needs to be a well-rounded approach and understand like where we're winning and appreciating where we're winning in the tax game.
Yep, absolutely. I agree 100%. There's a lot of unique strategies out there to be able to offset. And who knows what's going to happen in the future, right? There's a lot in the air right now. And people say, well, what do you think is going to happen in the future with bonus depreciation or other things like that? And, my cloudy crystal ball is just as clear as anyone else's in this realm. But we see that there's a lot of opportunity and we think there's a very bright future. And we're preparing for that future very diligently. We spend a lot of time researching unique incentives, especially in green energy and other things that our clients can take advantage of. And we're always learning and always adjusting. And someone who does that is extremely important to the overall success. And
Perfect. Yes, exactly. And so who would be an ideal client for you? Do they have to live in Utah? And then how would that ideal client get a hold of you after the show?
awesome. So we work with clients all over the country. We work with anyone from, you're just a W-2, maybe 100,000, 50,000 in W-2 to small to medium-sized business where they're starting out and they want to, these clients, we help them mitigate the pitfalls and set them up for success. And we've grown multiple clients over many of industries through their life cycle, right? All the way to sell and and retirement.
Yeah, you don't have to
And
just be a real estate
no,
investor. You
it could
just
be
have to be
all
someone who
kinds.
pays taxes.
Mhm. And that there's a lot of us out there, right, that pay taxes, right? So
Yeah.
everybody's inside of that. But I would definitely say real estate is something that we do very well, and we focus with a lot of high net worth individuals as well. We have offices here in, like I said, Draper, but we also have an office in Ketchikan, Alaska.
Hmm.
It was the once in a lifetime fishing trip that turned into a very nice sized office that many of us get to go up there and work with our staff that's up there, and we do a lot of governmental work up there, which is great.
Nice.
And we were just up there for the elections, for some of the um, other organizations are up there, and we did, we were on TV talking about election results and other things like that, and that was a lot of fun. But you can get a hold of us anywhere. You can go to the Teuscher Walpole website or Cost Segregation Consultants website. You can call our number at the office at 801-619-1400. You can get a hold of me, Matt Meyer, Matt M at trwllc.com. And I can put you in touch with one of our partners or senior managers that can reach out, and we can schedule some time for a consultation and see what we can do and how we can help you.
All right, perfect. Thank you so much, Matt. It's been a pleasure
Hey,
talking to you and educating us. I think that teacher mentality and that education mentality helps your clients win and it helps you win. So I love those situations where someone's teaching, someone's learning, and everybody's
no worries.
succeeding.
Thank you very much for your time.
Appreciate it.
Bye.